the HOA may have to qualify too. And that's the kind of surprise no buyer wants to discover halfway through an escrow. After they've spent the money, after they've invested emotionally, and after they've already started picturing themselves in the home. Today, I want to talk about why that happens, what lenders may be looking at, and why both buyers and sellers need to understand that sometimes having a qualified buyer just isn't enough. Hi, I'm Frank Spencer, Mr. Chatsworth, and on this channel we talk about real estate, local lifestyle, and the practical issues that can quietly affect value, financing, and whether a deal actually makes it to closing. And this is one of those issues, because when you're buying or selling a condo, townhome, or any property tied to an HOA, the community itself can become part of the financing conversation. Most buyers, well, they just never see this coming. Most buyers assume that if they qualify for the loan, they're in good shape. And that's how most people think about financing. They think about income, credit score, debt to income ratio, and cash to close. And yes, all of that matters. But in an HOA transaction, just may not be the whole story, because the lender may also take a hard look at the association connected to the property. That means the buyer can do everything right, get into escrow, begin making their plans, start imagining life in a new home, and then find out that the property itself doesn't qualify because of issues tied to the HOA. That's the kind of surprise that can kill a deal. Why the HOA matters to the lender.